Hey, what is good, everybody? Welcome back to the channel. Well, what is not good today is the stock market. Well, actually, it looks like it's starting to turn around a little bit. Ever since those Fed minutes came out, the market sold off pretty hard, but it looks like it is starting to rally. And I think if the market can end near the upper range of today's trading range, I think that's actually going to be a pretty decent sign for the market, but I'll get into the charts in a little bit. But what I wanted to do was talk a little bit more about the Fed, because they have been speaking a lot. They've been quite hawkish, and I think they're kind of spelling it out in plain English what is coming. So I just want to give you my thoughts on it, what I plan to do. But I'm going to start with this article, and this article says the Fed must inflict more losses on stock market investors to tame inflation, says former central banker. And another quote says, the Fed will have to shock the market if financial conditions don't tighten, says the former New York Fed chief Dudley. And then scrolling down here, it says the most telling paragraph is right here. It says, it's hard to know how much the U.S. Federal Reserve will need to do to get inflation under control, but one thing is certain: to be effective, it'll have to inflict more losses on stock and bond investors than it has so far. And that was also said by Bill Dudley, the former New York Fed president. So I think the Fed is trying to spell it out in plain English for us, so we can't say that they didn't say anything, we didn't see it coming. But I just want to read a little bit more from this article, and it says, that's William Dudley, the former president of the powerful New York Fed, arguing in a guest column at Bloomberg that his former colleagues won't get a handle on inflation that's running at around a 40-year high unless they make investors suffer. Yikes. And it says, there are a myriad of uncertainties the Fed must navigate, he acknowledged, including the effect of easing supply chain disruptions and a historically tight labor market. But the effects of the Fed's tightening of monetary policy on financial conditions and the effect that tightening will have on economic activity is one of the biggest unknowns. Now, he says, unlike many other economies, the U.S. doesn't respond directly to changes in short-term interest rates, partly because most U.S. home buyers have long-term fixed-rate mortgages. But many U.S. households, also in contrast to other countries, have a significant amount of their wealth in equities, which makes them sensitive to financial conditions. And we have more in equities now than we have ever before. And it says, Dudley's call for the Fed to inflict losses on investors stands in contrast to the longstanding notion of a figurative Fed put, the idea that the central bank would halt monetary tightening or otherwise ride to the rescue in the event of heavy losses in the financial markets. Dudley, who ran the New York Fed from 2009 to 2018, was previously chief U.S. economist at Goldman Sachs, and is now a senior research scholar at Princeton University's Center of Economic Policy Studies. So I don't think there's a lot of good news coming from this, but it says investors have talked of a figurative Fed put since at least the October 1987 stock market crash prompted the Alan Greenspan-led central bank to lower rates. An actual put option is a financial derivative that gives the holder the right, but not the obligation, to sell the underlying asset as a set level known as a strike price. I don't think we needed to go over that, but it just seems like when members of the Fed have spoken lately, the talk has become increasingly more hawkish, with hinting that a balance sheet reduction could begin as soon as next month, which has led to a bearish steepening in the rates. Now, the Fed's balance sheet has pretty much doubled to $9 trillion as a result of more asset purchases at the onset of the pandemic. Now, the liquidity provided by an expanded balance sheet has become a factor in the stock market's rally that followed, the short COVID-induced bear market in the spring of 2020, as well as the rise in the value of a range of other assets too. But so the big question is, where do we go from here? All right, well, jumping over to my TC2000 charting software, I just want to get into what I plan on doing from here. Now, I think the Fed is giving us a pretty clear-cut signal that, there's probably going to be a lot of rocky times ahead. Now, I personally think, and this is all just my opinion, before I get into any of this, please just remember, this is not financial advice. It's just my opinion and what I plan on doing. Please make all of your own investing and trading decisions. This might be right, this might be wrong, just a forecast, just a feeling that I'm getting, but I'm thinking that we're probably going to end up taking out this high before we end up taking this low, but I do think eventually we are going to roll over and take out this low. So if we get a move up in the market like I'm hoping that we get, I'm going to lighten up on some more of my stocks. Now, normally I like to be in right around 10% of cash or maybe a little bit more. On this little move down here, I put some cash to work, and I ended up going down to about 4% cash, and that's something that I'm personally not comfortable with. Some of you guys may be comfortable being all in stock. Some of you like more cash than that. Like I said, I like to be personally right around 10%. So I use this up move in the market over the last couple of weeks to trim some of my positions a little bit. I'm sitting at about 12% cash right now. I'd like to be around 15 to 20% in case we get this rollover. I want to take advantage of that volatility in the market and try to scoop up some stocks that I want to own for the long term at a lower price. But that's just the kind of feeling that I'm getting in the market. We're going to end up taking out this little move up here. Probably end up having a little move like this. Let me move this over to the side a little bit. And then, kind of chop around a little bit. This is just a guess, so please don't hold me to it. And then eventually, I think we're probably going to have a little bit of a rollover in the market, and who knows how low we end up going. I'll have to, look into the charts a little bit more where I think those projections could be, but that's the kind of feeling that I'm getting we're going to get in the market. Let me move back here. Now let's look at the current trading. Now this is the first video that I'm making this week. I was away from the market most of the day on Monday and some of the day on Tuesday, so I didn't get a chance to make a video. But I was talking to the Patreons that I thought this move right here was going to be a fake out, and it looks like we're rolling over from there. One of the reasons why I thought it was going to be a fake out, number one, the volume was really light that day, plus it just seems like there's a lot of things that they're doing to trick traders like me, things that worked in technical analysis, 10 years ago or so. They're kind of sending it like one step further, like how they send it above this 200 period simple moving average just to send it lower. Now it seems like they try to make these little bullish I call them J-hook patterns, but right around those moving averages after a sell-off to kind of make us think that the next leg up is starting, and then they send it down one more time. And you can certainly see after yesterday's sell-off, I definitely thought we were going to get some follow-through. Unfortunately, I didn't get short anything, and you can see today's down move in the market is coming on a larger volume as well. So after you get like a move like we had on Monday, if we have a day down the next day, that's a big day down, and it's on above average volume, you tend to get some follow through the next day. But there's still some time left in today's day, and if we can end above this purple line, this 21 period exponential moving average, I think there's a very good possibility we're going to end up filling this gap at least, so heading up to about 360. Now this is the area in the market that I was looking at in the short term for a bounce. It was right around that 50 period simple moving average, plus we had this support right back here from the end of February and early March. So this is where I was kind of waiting. I had a buy order in at 349.50, but the QQQs never made it down that low. I wouldn't be a bit surprised if we come down there tomorrow and have a bounce. So that's the area of strongest support that I'm looking at for the QQQ. If we do get that move down to that area, I probably do plan on taking a small position for a bounce. Now, if we do get a slice through this support area and it ends up following through the day after that, I think this rally is in big trouble right here. I don't think it's in a rally yet, but that's what it would take for me to really get bearish on stocks in the real short term like this week. But I think the market overall is digesting those Fed minutes pretty good, especially since it's, has the potential of ending towards the high of the day. But let's take a look at the spider, the S&P 500. You can see basically the same thing. I was also looking for support down there right around that 50-period simple moving average on the S&P 500. It did not make it to that area either, but that's the area on the S&P 500 that I'm looking at. If you look at the diamonds, you can see the diamonds came all the way down to that 50-period simple moving average today, but I kind of expected it to break through and come down to this support area right around 340 and a quarter, but it did not make it down there yet. So that's the area that I'm watching on the diamonds. But all in all, I think if the market can end near the high of the trading range for today, that's going to be very bullish for stocks. If it ends towards the low, it's going to be really interesting to see where everything opens up tomorrow, because if it opens up down big tomorrow, I think the current rally is in big trouble. All right, well, before I end the video, I'm going to go over my recent trading activity. I didn't make any day trades today or yesterday, but I did make one on Monday before I had to leave the house, and it was in PLX. Let's go to the minute chart. I'll show you how this one shaped up. Let me finagle this chart so we can see it. There we go. By the way, I do have a Patreon group. I talk about these trades in the Patreon before the day starts. So if you're interested in that, that link is down there in the description. It's only $10 a month. I am in the Discord every single day, and I also put out a pre-market watch list video where I talk about stocks like this that I am watching before the trading day. Let me see if I can get this thing. There we go. Well, PLX had that nice gap up, ran up just a little bit, but then pulled back into that 8-period exponential moving average, started to round up. You guys know I love trading these rounded bottom patterns in these gap and go type of chart patterns. I put in my order to buy just above it. It was executed at $1.61. Actually got a pretty good fill, and I had my order set in to sell at $1.74, so it was about an 8% gain. I like to grab at least or grab right around 6 to 8% on these type of day trades, so I got that rather quickly. It only took a few minutes. Now if we pull this thing forward, you can see that PLX, if I can get this to move, see PLX actually went quite a bit higher, went up to a little bit over $2 a share, so there certainly was more money to be had if I wanted to hold on to it that long, but eventually it did end up rolling over in that trading day. So usually these things end up gapping up and they're just kind of rolling over, even though today, if I go all the way to where it is right now, you can see you're starting to get another little pop in PLX. So this one might be starting its next leg up. Let me zoom a little bit closer here. Definitely a nice looking pattern. Didn't even make it down to 8-period exponential moving average for it. Had that nice turnaround candle. So this one might be worth watching for tomorrow. But another update that I want to give is on BitNile, ticker symbol NILE. This was a swing trade, and I said in my video where I talked about it that I was going to place my stop loss under this support level, and unfortunately it stopped me out yesterday at 68 cents. So now that I am stopped out in that stock, it's probably going to take off. So if any of you guys are sitting in this stock, you're welcome. Now that I'm out, it's probably going to explode. But that was my trading activity for for the last couple of days. If you guys have any questions, or if you see any cool stocks setting up for nice swing trades, make sure you let me know down there in the comments section. I love it when you guys leave me trading ideas. I trade them probably a little bit more often than you think. But I'm going to end the video right there. Thank you so much for watching my video all the way to the end. And until next time, take care, everybody.